Welcome back to another monthly themes episode brought to you by Convergent Wealth Partners. In this episode, I will go over equity returns for the month of October, and then Max will cover key economic indicators. The S&P 500 showed a strong rebound from the lows of September, finishing the month up 6.91%. The Nasdaq 100 had the strongest monthly performance of the indexes at 7.9%. The Dow Jones notched an all-time high, but relatively underperformed compared to the Nasdaq and S&P, despite finishing the month up 5.84%. Small caps also had a positive month, but continue to stay range-bound since their all-time highs in March. There was also a strong rebound not just from U.S. equities, but from global equities, as the MSCI World Index was up 5.59% for the month. Looking next at commodities, with inflation seemingly here to stay longer than expected, commodities rose another 3.84% in October. Gold was up 1.53% for the month and managed to top $1,800 an ounce for the first time since May, as U.S. 10-year Treasury yields dropped from 1.68% to 1.55%.
We will now move to the economic data portion, beginning with total claims. Total unemployment insurance claims fell further in October to slightly below 3 million. This number is roughly double the normal pre-pandemic level for total claims. While the decrease in claims is definitely a positive sign, the main catalyst behind this is the expiration of benefits. And so we expect that a lot of people that remain unemployed are not accounted for in this because they're no longer able to receive benefits. Since spiking to historic levels in March 2020, new claims for unemployment have continuously fallen and now sit just above pre-pandemic levels. This week's reading of 281,000 is the lowest level of claims since March 14th of 2020 and shows just how far we have come during that span. Also falling to a new pandemic low was continued claims, which came down to 2.24 million in October. This represents a fall of over 200,000 from the previous week and over 5 million from the previous year. And again, while these are both positive signs as we're seeing pandemic lows in claims really across the board, the large catalyst behind this is the expiration of benefits. And so many people remain unemployed, but are not counted in this total. After spiking in Q2, we expect year-over-year GDP to fall in future quarters. However, we anticipate the continued economic reopening to support higher than pre-pandemic levels of GDP for at least the next year. As is evident to nearly every consumer, year-over-year CPI remains elevated well above pre-pandemic levels and is actually expected to increase in future quarters. And while this has provided support to the stock market in the near term, we do see some concerns here if inflation starts to run away in the next year or so. Year-over-year pending home sales fell sharply for the second straight month in September. While this may have been caused by the slight increase in interest rates, we also are likely seeing the effects of the quick recovery in the housing market after the initial economic reopening. And so if we remember back to the summer and really into the fall of 2020, we saw this really quick pick back up in the real estate market while everything else was a little bit slower. And so the result of that is that now all of those other things that recovered a little bit slower, they're seeing really strong year-over-year numbers, while things like real estate that recovered very quickly are seeing some slowing. Another concerning data point here has been the crash in consumer sentiment, which fell again in October and remains near 10-year lows. And so the major risk here is that while the stock market is just shooting towards all-time highs and makes a new all-time high nearly every single day, consumer sentiment is actually now below the levels of March of 2020. And so as a result, what we could end up seeing is some small event taking place that really causes a major correct between these two variables, and that could lead to some major losses in the markets. So in summary, after sustaining large losses in the month of September, the market roiled higher in October, largely on the back of some strong leadership in big cap tech. However, many concerns do persist, with lots of the year-over-year economic data indicators beginning to slow, inflation continuing to accelerate, and the further disconnect between consumer sentiment and the stock market. So while market participants have enjoyed a really massive rally in the markets over the last year and a half, many economic and political concerns lie in the months ahead. For this reason, we have shifted our convergent investment philosophy to an all-weather approach that is designed to perform well in any market environment. We hope that you have enjoyed getting this in-depth look at our market research and look forward to providing it to you each month moving forward. Thank you from the entire Convergent team.